Right. Right. What will happen is, I think next week will be our last session, if I'm not wrong, for this module.
I think so too. Yes.
So if it's there, I will just verify. But if it's the, or maybe let me just quickly check. But if it's the last one, what will happen is, I might say, maybe, let me just verify. Uh, Either there are two ways. There are two ways. Number one, because I intended to do with you guys a revision class that looks at overall almost everything that we've been
Okay.
doing. So if now there's one topic that it will be missing after I've done with you the non-current assets held for sale, which is the effects of transactions in foreign currency. So in case we are writing the other week, there are two ways that I can sort it out. Either on Saturday we do the normal class on
The 13th.
on effects of transactions in foreign currency. Is that right? Then on Sunday we do the revision on all things. Or alternatively, we can do the transactions in forex through the revision. Because actually it's not all that hectic.
It's not
It's one of
much.
the
Yes.
cheapest topics actually for this
Okay.
module. Let me just verify. I'm just verifying the dates there. FAC 3702. All right. 15 May. Today it's what? 6.
Yes. Yeah. 15 May.
Yeah, so that'll be 13. Okay, so that means Tuesday the other Monday the other week. Yeah, so that's Monday.
Yes.
So what will happen is I'll organize a revision class. That revision class, if we do it Saturday, I can just incorporate it with the stuff for forex. Then we'll do it in that class. Is that right?
Yeah, that sounds fine.
Right. So I sent you the notes on effects on non-current assets held for sale. So I hope you managed to read on that. So today we are going to try to do I will use the question to illustrate the concepts of non-current assets held for sale. Right. It can happen that an entity might decide to sell a non-current asset. Right. But it might take time. You would find that normally, if you want to get a good price, you might take time to sell your asset. So now, because of that, there will be a gap between the date that the decision is made and the date that the payment is made. So when a decision has been made to sell an asset, according to IFRS 5, from that moment, that asset should no longer be considered to be in its original category. That means if it was PPE, we have to remove it from PPE and transfer it to non-current assets held for sale. If it was investment property, it has to be transferred from investment property to non-current assets held for sale. So whatever category it was, we have to transfer it to non-current assets held for sale. Right. Then it can happen that the transfer can happen during the year. Let's say our year started in January, then in 31 May we decide to sell. Our year is ending in December. That will mean that on 31 May, when we decide to transfer, we'll account for the asset according to the previous category. If it was PPE, that means if we're providing depreciation, we'll just provide depreciation for the 5 months from January to May. If there's any testing of impairment, we also do the testing of impairment. Then after that, we'll then transfer the asset to non-current assets held for sale. Then from that date, it will no longer be depreciated, because when it's now under non-current assets held for sale, the asset will now be recorded at fair value less cost to sell. Fair value less cost to sell. And on initial recognition as a non-current asset held for sale, we can recognize some impairment. Right. And that impairment can be reversed in future if the fair value less cost to sell becomes more than the recoverable amount. I think we did the impairment of assets for us to determine the fair value less cost to sell. Right. So now we want to look at examples to see how we account for such assets when such decisions have been made. All right. Let's look at question 1, machinery. Right. On 1 March 2015, James Limited purchased a manufacturing machine for 985,000. On acquisition date, it was estimated that the machine had a useful life of 10 years with a residual value of nil. The machine was available for use as intended by management and also brought into use on 1 April 2015. Remember the difference between available for use and brought into use. Available for use is the date that accounting begins to provide for depreciation. Sorry, just a second. Can I just check for some? Just 1 minute. Right. The difference is that the available for use is the date that we begin to provide for depreciation, whereas the brought into use is the date that SARS will begin to grant the tax allowances. Right. Now they say that due to the lack of technically skilled operators within the company to efficiently operate the machine, the directors decided to sell it and to outsource the manufacturing process to the third parties. On 31 August 2016, all the criteria to classify the machine as held for sale, as stipulated in IFRS 5, non-current assets held for sale, and discontinued operation was met. Right, there's criteria. I think you can check. I think you know that these days they usually like to ask your questions. We have criteria that has to be met for us to conclude that the asset is now held for sale. So you can just go and read the criteria. It's on the documents that I sent during the week. All right. The management expects the sale to be completed for cash on 31 January 2017. On 31 August 2016, the fair value less cost to sell of the machine was estimated to be 800,000, which remained unchanged on 31 December 2016. All right. Now the question is required to disclose the following notes to the annual financial statements of James Limited for the year ended 31 December 2016. Right. So this asset will be accounted for according to the provisions of PPE. That is from the beginning of the year until 31 August, the date on which it was now held for sale. Then from 31 August, it will now be using the provisions of IFRS 5, that is non-current assets held for sale. Right. So now let's do the notes. Right. We have extracts of the notes to the financial statements. James Limited for the year ended 31 December 2016. Number 1, property, plant and equipment. This is machinery. Right. Remember, when we do our PPE, we start with the carrying amount at the beginning of year. Then our carrying amount at the beginning of the year will be made up of our cost and
Accumulated
accumulated
depreciation.
depreciation. That is at the beginning of the year. Right. Our costs were given that this machine was acquired for 985,000. Right. So that's 985,000 is the cost. Right. Our year is ending in December 2016. So when you calculate your accumulated depreciation at the beginning of the year, you'd calculate up to 31 December 2015, the end of last year. So we'll have we're told that the following is an extract of the accounting policies of GEMS. Right. Amortization and depreciation are written off in accordance with the straight line method over the assets estimated useful life. Right. So there will be a amortization and there will be depreciation there. Right. Now, if we can check here, the asset had a useful life of 10 years and a residual value of nil. Right. The machine was available for use on 1 April 2015. And we want to calculate depreciation up to 31 December 2015. So
2015.
April to December, you would find that that's 9 months. That's
Yes.
9 months. So we're going to say 985,000 985,000 we will divide by 10, multiply by 9, divided by 12.
Yes.
What do we get?
73875.
So that will be our accumulated depreciation for last year. Actually, it was actually bought in the previous financial year to the one that we are currently reporting. All right. That means our carrying amount $911,125. All right, then depreciation for the year. Or as long as the decision was made during the year, we have to depreciate for the months up to the date that the decision was made. All criteria was met on 31 August 2016. So we'll depreciate the machine from the beginning of the year, that is 1 January, up to 31 August. That is for another 8 months. So we'd say 985,000 divided by 10, multiplied by 8, divided by 12. What do we get?
65667.
65?
667. Yes.
Yes. Right. Then we have to test for impairment. Right. Our carrying amount is 911,125 minus 65667. What do you get?
Sorry. Minus 925. I get 845,458.
845.
Yes, 845,458.
Right. Remember that there is impairment if the carrying amount is
more
greater than the what?
Recoverable amount.
Recoverable amount. Is that right? So we're going to
Yes.
see if there is impairment there. Right.
Yeah.
So first of all, let's see. We'll then transfer the asset, non-current assets held for sale. This abbreviation is allowed even in your Excel. Is that right?
Yes.
That means 845 at the carrying amount 458. Right. Then we get our carrying amount at end of year, which will be made up of cost,
First.
accumulated depreciation. What will be our cost at end of year?
It would be nothing, I think.
Perfect.
Yes.
Because what? This asset has been transferred to non-current assets held for sale. But it's not always that it will be zero. If we had other machines that are still being used, they were going to make up the carrying amount at the end of the year. Is that right?
Yes. Yes.
Right. Then that would be the note on property, plant, and equipment. Any questions there?
No, good on that one.
Right. Then non-current assets held for sale. Right. When you do the note on non-current assets held for sale, you have to disclose the decision that was made when the sale is expected to be made, to be concluded, and if there's a reason why they to sell the machine, you can also incorporate it in that description. Then you also have to list the assets that are part of the non-current assets held for sale. Remember that the non-current assets held for sale can either be a single asset or it can be a group of assets, which we call a disposal group. Right. And if there is any impairment recognized, we have to what? State it. Right. If we can see here, the carrying amount was 845, but the fair value less cost to sell was 800. So because the carrying amount is more than the recoverable amount, there will be an impairment loss. Is that right?
Yes.
So impairment loss on initial classification. As held for sale. That will be 845,458 minus 800,000, which will give us 45458.
58.
Right. So let's first find the major factors that we have to. Right. The things that have to come up here that is that we are going to sell because of the lack of technically skilled operators in the company. We have to state that. And we have to state that on 31 December 2016, that's when they decided to sell the asset. We also have to state that it is expected to be completed for cash on 31 January 2017. Those things should be should come out in our notes. So actually, we can say on 31 August 2016, that is the date when all criteria was met. Right. James Limited decided to dispose of machinery right? Then our reason, due to lack of technically skilled operators to efficiently operate the machine. Right. It is expected that the sale of the machine will be completed for cash on 31 January 2017. For an asset to be held for sale, we should expect the sale to be concluded within 12 months.
12 months.
Then we list the assets, machinery at the fair value, which is 800,000. Right. And impairment loss of 45,458 was recognized upon initial classification. As non-current assets held for sale. The impairment loss. So you only include these statements if there was an impairment loss, because sometimes you might find that the fair value might even be more than the carrying amount, so there will be no impairment loss. In the profit or loss section, of the statement of profit or loss and other comprehensive income. In the other expenses line item. Right. So this is how we structure the non-current assets held for sale note. I think there will only be a difference if we are dealing with a disposal group. I think I'll show you how to do a disposal group. I think maybe it might be next week. Right. Any questions there?
No.
Right. Let's do one more on this single asset, then we know that we are comfortable. Right, question 2. Property in Sandton. On 1 January 2015, Fashionista Limited acquired a property in Sandton for 2.7, land 1.1, building 1.6, with the intention to earn rental income from it. Right? When the entity intends to earn rental income, that means the asset is property planning, it's investment property. It's investment property. Right. On 1 March 2015, Fashionista Limited entered into a 5-year lease contract with Mr. Smith, who uses the property for residential purposes. On 30 June 2016, management decided to sell this property and replace it with another bigger property in the same area, which will be used for the expansion of its own business. On 30 September 2016, the sale of the property in Sandton met all the requirements for classification as held for sale in terms of IFRS 5.9 and non-current assets held for sale. So although they decided on 30 June, all criteria was met on 30 September. So this asset will only be transferred from investment property to non-current assets held for sale on 30 September 2016. The sale is expected to be completed on 1 February 2017. The property is marketed by an estate agent at a reasonable price compared to its fair value and will be sold for cash. Those are factors that just support that the criteria has been met. Because for the criteria to be met, you should be actively marketing the asset, and you will be expecting to sell it at a price which is reasonable compared to its fair value. Right, the fair values of the standing property is determined by an independent sole appraiser on the respective dates are as follows. Right, so these are the carrying amounts. Now, accounting policies, the following is an extract of the accounting policies of Fashionista. Investment properties accounted for in accordance with the fair value model. The carrying amount of investment property will be recovered through the sale of the property. Right, disclose the notes to the annual financial statements of Fashionista Limited for the year ended 31 December 2016. Right, first of all, it's investment property. Right. Right, question 2. Extract of the notes to the financial statements of Fashionista Limited. For the year ended 31 December 2016. Investment property. Sorry, I think we should have we have land, we have buildings, we have total. Right, we have carrying amount at the beginning of the year. Right, we first have to, the carrying amount at the beginning of the year, if investment property is being measured at fair value, will be the fair value at the end of last year, which is 2015. So on 2015, our fair value was this one. That is 1.3 and 1/8. So we're going to say right. Right. If a investment property is measured at fair value, then on the date of the transfer, we'll have to remeasure it at the fair value on the date of transfer. Remember, 30 September 2016, that's when all criteria was met. If you can see, all criteria was met on 30 September 2016. So the fair value was now this one here. Right, so we'd say fair value adjustment. Fair value adjustment will simply be the difference between the new value and the old value. Right, so we'd say 1320 minus 1.3 million. Then 100 minus 1,870,000. What do we get?
I think the 100. Let's see. 100 minus 187. I am getting 230,000.
30,000. Is it 30 or 200?
230.
Right. Thank you. And the first one?
The other one was 20.
20,000.
Yes.
All right. Then immediately we then transfer to non-current assets held for sale. At the values. When we transfer, we subtract. Then we get our carrying amount. At the end of year. So there will be nothing at the end of the period. Any questions there?
Nope.
Right. Then we do the non-current assets held for sale. Right. In our non-current assets held for sale, we have to bring out the following. That they decided to sell it in order to replace it with bigger property. Right. And this decision was made on 30 September. We mainly use the date when all criteria was met. Right. Or then we can say the sale is expected to be concluded on 1 February 2017. Right. And will be for cash. So we're going to say on 30 September, (2018), management decided to sell the investment property and replace it with another bigger property. In the same area. Right. It is expected that the investment property will be sold for cash on 1 February 2017. Then we'll have our investment property. But remember that the reporting is being done on 31 December. So it will now be at 3.5.
3.5. Okay.
And you should know that on investment property, we don't recognize impairment. Assets held, there are specific assets for which, even when classification is held for sale, we don't recognize impairment. For example, investment property, financial assets, financial liabilities, inventory. So assets that are already recorded at fair value, we don't recognize any impairment on initial recognition. So that is how we'll be recording that. Any questions?
No.
Right.
No.
So the last one that I would like to look at for today, question 3, you can do it at your own time.
Okay.
They are the same. Question 3 and 4, they're just the same with what we've been doing. Right. I will look at question 5. I will look at question 5. Right. Due to a significant price increase in respect of raw materials used by Avion Limited to manufacture a special soap, management decided to disclose the manufacturing of this soap and to dispose of the related assets and liabilities in a single transaction. On 30 April 2014, the company complied with all the requirements of IFRS 5 non-current assets held for sale and discontinued operations, and the disposal group was classified as held for sale. Management indicated that the disposal group will be sold for cash on 31 January 2015. This disposal group consists of the following. Right. Then the question is calculate calculate the impairment loss to be recognized in Avion on initial classification of the disposal group as held for sale. Right. The first thing that we have to do is to calculate the carrying amount of the disposal group. Right. So Dave, question 5. Calculation of impairment loss. On initial classification. Right. Our step 1, we have to calculate carrying amount of the disposal group. So we have to go first of all with the assets one by one and calculate their carrying amounts, then minus the liabilities. Right, the land, it had a value of 531. It is the accounting policy of the company to account for land and the administrative building in accordance with the cost model. So if they are using the cost model, that means the land will still be at 531,250. It will not change. Remember that land is not depreciated. So we can say land would be 531,250. Right. In the admin building, we're told that the administrative building is depreciated from here in accordance with the straight line method over the expected useful life. At the beginning of the current year, the remaining useful life of the building was estimated to be 12 years after an impairment loss of 18,750 was recognized on 31 July 2013. Assume that the building had a residual value of nil and that no impairment loss was recognized in respect of the land on 31 July 2013. So first of all, we have to calculate the carrying amount of that building. Right. So this is the carrying amount, which was 2265. Administrative building. Carrying amount 1 August 2018. Right. They are saying this carrying amount was after an impairment loss of 18,750. So first of all, we have to analyze it before the impairment loss. So we'd say 2265, 625. 2013, 2265, 625. Let's first add back, because we need to know the carrying amount before the impairment. What do you get?
Okay, sorry. Let me start again.
What are you getting?
22, 65, 625, 118, 750. It is 2,284,375.
All right. Then depreciation. Remember that was the carrying amount on 1 August. Now the depreciation, we know that the remaining useful life was 12 years. Right. Residual value is nil. And the classification happened on as held for sale, happened on 30 April 2014. So from the beginning of the year, which is the beginning of the year was, what was the beginning of the year again? What is our year end year? It's 30 April 2014. So it's a full year, isn't it? Was they
Yes.
complied with the requirements by the end of the year, right? So that means it's a full year depreciation. So would say 2,284,375 divided by 12. What do we get?
It's 190,365.
Right. So the carrying amount would be this plus that. So that would be our carrying amount of the admin building. Right. Then we have got the investment property. Right. We are told that it is the accounting policy for the company to account for investment property in accordance with the fair value model. On 30 April 2014, the fair value in the principal market of the investment property was estimated at 937,500, while the cost to sell will amount to 11,250. Right. So the fair value investment property. So you measure it at the fair value excluding cost to sell. Fair value excluding cost to sell. Remember that when you are measuring an asset at fair value, you don't consider the cost to sell. So it will be 937,500. So please, you don't take into account the cost to sell. That is the cost of selling the building. Right. Any finished goods. finished goods, we know that they will be recorded according to IS2, lower of cost and net realizable value. Right. On 30 April, the net realizable value of the finished goods amounted to 200,000. The cost is 192,500. So we're going to use the cost, which is lower.
The cost. Yes.
So finished goods, use lower cost, which is what? 192,500. Right. Then accounts payable, we're not told anything. Accounts payable, we normally take them at their book value because that's a financial liability. Is that right? Share investments. The share investments were determined, were designated at fair value through profit or loss from the date of acquisition in terms of IFRS 5.9. On 30 April 2014, the fair value has increased with 32,500 to 237,500. So the fair value will be 237,500. Right. So we'd say share investments. $237,500. Right. So then we can calculate the carrying amount of the disposal group. Is that right? So we'd say our land 531,250. Our administrative building 2094,010. We'll have our investment property 937,500. Would have our finished goods 192,500. Would have our accounts payable. Always remember that your liabilities would subtract, which is 75,000. We'll have our share investments. Right, we have 237,500. Then we get the carrying amount of the disposal group. Right, that's our carrying amount of the disposal group. Then step 2, determine fair value less cost to sell of the disposal group. Right, we are told that fair value of the disposal group was 3,886 and the cost to sell were 125,000. So we subtract the two amounts. So we'd say 3,886 250 minus 125,000. What do we get?
3,761,250.
Right. So that would be step 2. Then step 3, you then have to determine impairment loss. That is if carrying amount
Bigger than
is
recoverable.
greater than what?
Recoverable amount.
The fair value. less cost to sell. Is that right? Right. Now we found that the carrying amount of this disposal group was 3917, but the fair value was 37. So the carrying amount is more than the recoverable amount. So say 3917 760 minus 3761 250. What do you get?
Um, 156,510.
156,510.
Yes.
Right. So that will be the impairment loss. So this is how we calculate the impairment loss. Any questions there?
No.
Sorry, our friend, you came in late there. Right. So that was the solution to this part that says calculate the impairment loss. So that would be the impairment. Oh, sorry. So remember that. Right. That is the impairment loss that is of the disposal group. Right. Then the second part wants us to disclose. Right now, before you disclose, when we disclose, first of all, we have to allocate the impairment loss to the assets in the disposal group. Right now, the impairment loss is not allocated to assets that were recorded at fair value prior to recognition as non-current assets held for sale. That means we don't allocate to investment property as long as they were using the fair value model. But if they were using the cost model, we're going to allocate. So all assets that were measured at fair value, they will not have any allocation of impairment loss. Right, and we don't allocate also to inventory. That is because remember that it's already recorded at the lower of cost and net realizable value. And we want to also recognize it on accounts payable and share investments. That is assets that are and liabilities that are recognized in terms of IFRS 9 financial instruments. So those assets we don't. So all assets that were already recorded at fair value should not have any impairment loss allocated to them. Then so that means in this case, we're only going to allocate this impairment loss to these two assets. And to allocate them, we allocate according to the carrying amount, right? So we can say our right. So we'd allocate to the land, which is 531,250, and the administrative building, which is 2094. Right. Let's remember that a part of the impairment, the impairment to be allocated right. Our total impairment is 156,510. But we are told that there's an impairment loss of 18,750, which is already allocated to administrative building. So if there's any impairment already allocated, we allocate it to the assets. So no, I think I will have to do this afterwards. Let me just first finish this. Right, would say this is equal to this. Right. Then to allocate, we're going to say for the building, it's 531, 250 divided by 2625, 260, multiply by the impairment loss, which is 156, which we determined up the 510. What do we get?
It's 312
312
840
312
850
It's what?
850.
Are you sure? That seems too big.
Seems to be. Let
That
me see.
answer.
Let me do it again. Let me do it again. 531 250 divided by 26 2625 16 plus 6 15. Sorry, it's 31672.
Right. Then the other one we say 2094 010 divided by 2625 260, multiply by 156 510. What do we get?
Looks big as well. Let me see again. 209. I'm getting 124838.
Right. So then we can be able to do our note. Extract of the notes to the financial statements of Avion Limited for the year ended 30 April 2014. We'll have our disposal group. So just like that other single asset, we have to disclose that the decision to dispose of the group, why they are disposing the group, and show all the assets and liabilities in the group. Remember that this group on 30 April, that's when all criteria was met. They decided to discontinue the manufacturing soap and dispose it. Right? They didn't give us the reasons. Oh, okay, it's here due to the significant price increase in respect of raw materials. And the sale will be sold for cash by 31 January 2015. So we have to bring those things across. So we can say during the year, let's say 30 April 2014, Avion Limited, decided to dispose of, was it an outlet or what? Manufacturing of the soap. Due to a significant price increase in respect of raw materials. Used by Avion Limited. In manufacturing the special soap. All criteria for classification as held for sale were met on 30 April 2014. And the sale is expected to be concluded for cash on 31 January 2015. Right. The disposal group under discussion comprises land. Right, the land will take the carrying amount, which was 531, 250. Then we subtract the impairment 31, which was allocated 31672. What do we get? Here, the impairment that we allocated here would subtract to the carrying amount that we had before the classification.
499,578.
We do the same for the administrative building. 2094010 minus 124,838.
1969172.
1969 what?
172.
Right. Remember, we said we don't allocate a impairment to the other assets. So the other assets will just take them as they were in the carrying amount. Right. So get to 823,750. Something is wrong here, because we should get our carrying amount, this one. What is it that is wrong? There's a calculation that should be wrong there.
Mm.
Did I leave out anything there? Oh, I see. When I copied these other assets, I didn't copy the investment properties.
Oh. Of 937.
Right. That's it. So you'll be getting your 3761,250 here, the fair value less cost to sell. Right. Then you have to state that we recognize so an impairment loss of, right. Can you calculate the impairment loss that was recognized? We calculated 156,510, but remember on the building they'd already recognized 18,000 and something. So they only recognize the additional. They'd already were told that after an impairment loss of 18,750 was recognized on 31 July 2013. So they already had an impairment loss of 18,750. So we can say minus 18,750. What do we get? So you take out, we take out the impairment that was already recognized in the previous years, because it's already there in the books. So only recognize the additional impairment. How much is it?
Okay. 137,760.
Right. 76 what? 0.
0. Yes, 0.
Yeah. Right. Was recognized. Thank you. Was recognized upon initial classification. Of the disposal group. Is held for sale. The impairment loss was included loss after tax. Not loss, we can say profit. We don't know if there was a profit or loss. On remeasurement. Of the statement of profit or loss. Right, so this is how we disclose if it's a disposal group. Any questions? Right, if we don't have any questions, then thank you very much. So we'll meet next weekend for our final session. Right, for our friend who was not in, next week we are going to organize a longer session, either on Saturday or on Sunday. I will confirm by Friday, so please check your groups by Friday. I will have a longer session. It will either be on Friday or Saturday. So I would think if, depending on the other modules, revision classes, I might maybe also do the class on Saturday because I need to do the effects of transactions in foreign currency. But I'm deciding that maybe it can just be easier to just do it in one session. So we'll just organize one session. It will be longer, maybe a minimum of about let's say 3 to 5 hours, whereby I will just try to do the concepts in the other topics that we have done so far. So it will be like a revision, but I will try to make sure that 3 to 5 hours we'll do that class. Thank you so much, and God bless you richly.
Thank you.